Modern markets move at a dizzying pace. Algorithms trade in microseconds, and the constant barrage of financial news makes the stock market feel less like an exchange and more like a chaotic, high-speed casino. Wall Street thrives on this chaos. There is a massive financial incentive to convince you that they have a secret formula, a brand new strategy to beat the competition, and that you need to be actively trading to keep up. But the truth is, humans just have an enormous enthusiasm for gambling. Both the financial system and the state actively cultivate that mindset because generating constant transactions creates a reliable stream of fees, commissions, and tax revenue. Then you have Warren Buffett. At nearly 95 years old, his approach is the exact opposite of that frantic trading. He is the ultimate counterindicator, relying on extreme patience instead of constant nervous action. Today, we are going to apply Buffett's famous noise versus signal filter. We'll test it against three massive modern market panics happening right now: Apple's fight with OpenAI, a historic IRS penalty against Coca-Cola, and shifting interest rates at the Federal Reserve. Surviving the modern market doesn't require faster algorithms. It requires adopting Buffett's specific information filter to separate fatal business threats from cynical Wall Street noise. Look at the recent panic surrounding Apple. Just last week, Apple filed a lawsuit accusing OpenAI of attempting to steal its trade secrets. For the broader market, this looks like a terrifying technological threat that could disrupt their entire ecosystem. Buffett views this entirely differently. He sees business as a brutal, constant dogfight, where extremely smart competitors are always shooting at you, trying to figure out how to make your future less bright than your past. It's a given. He learned this early on. In his early 20s, Buffett owned a half interest in a Sinclair gas station. The Phillips station right next door pumped 30,000 gallons a month, while Buffett's station pumped only 15. Despite all his business school knowledge, the competitor crushed them, and they eventually had to close up shop. That early failure taught him the absolute rarity of finding a master operator. He refers to CEO Tim Cook as a Stradivarius. If you have a Stradivarius playing the violin for your business, you don't spend the next 3 centuries looking for another one. True deep value is found in holding on to exceptional management through these brutal competitive cycles. You do not panic sell a generational company just because of a scary tech headline. The same logic applies to regulatory threats. Take Coca-Cola, a position Buffett has held for over 45 years. Right now, the company is facing a massive lawsuit from the IRS over their overseas accounting practices, with the government demanding roughly $20 billion. This specific lawsuit isn't isolated to Coca-Cola. A huge number of American businesses structure their accounting similarly, meaning the derivative effects of this ruling could create a massive chain reaction, impacting the entire corporate sector. So how does Buffett react to an existential regulatory threat? He looks strictly at the downside. His conclusion is that even if Coca-Cola has to pay the entire penalty, it won't actually break the company. The underlying business will keep churning out cash. That is the definition of downside protection. It's the ability of a core business model to absorb an absolute worst-case scenario without facing structural ruin. Rigorous due diligence means verifying that the underlying economic engine is indestructible. Once you know a company can take a direct hit and survive, you can confidently ignore the noise of a catastrophic legal headline. But what about the broader economy? Buffett has often described interest rates as the gravity of the stock market. They dictate the pricing of every single asset class you can buy. Right now, the market is obsessing over the new FOMC chairman, Kevin Warsh. Analysts parse every word he says to Congress, trying to guess exactly how he will balance the Fed's dual mandate of controlling inflation while maintaining maximum employment. It is an incredibly high-pressure position with impossible expectations. Historically, past Fed chairs, like Paul Volcker, received actual death threats for the tough economic decisions they had to make to stabilize the country. Buffett respects the difficulty of the job, but he refuses to base his portfolio on predicting their next move. He accepts that macroeconomic shifts are entirely uncontrollable, and he actively refuses to align his investments with the short-term horizons of political election cycles. Making portfolio decisions based on when you think the Fed might cut rates or who wins the next election is gambling. It is not investing. The reality of generating long-term wealth is actually a very simple business. It requires buying undeniable value and holding it, a philosophy Buffett built and refined alongside his late partner, Charlie Munger. The moment you start overcomplicating that process by reacting to AI hype, IRS lawsuits, or Fed minutes, you step out of the role of an investor and revert right back into being a gambler. This unshakable conviction is the legacy Buffett is actively passing down to his successor, Greg Abel. He trusts Abel implicitly because he's seen him maintain this exact discipline across countless high-pressure situations. True, multi-generational wealth isn't generated by finding a secret algorithmic edge. It is built solely by filtering out Wall Street's cynical noise and maintaining absolute conviction in deep business value. If you want to build lasting wealth, you have to step out of the casino. You have to conduct your own rigorous due diligence and look past the top-line panic. To help you do that, we've developed tools like the Buffett Indicator and Bubble Watch Dashboard. They offer practical, mathematical ways to apply this exact noise versus signal filter to your own portfolio, showing you where the market is overheating and where real value remains. As always, this video is for research and entertainment purposes only. Please conduct your own due diligence before making any financial decisions. Thanks for watching.